Okay, so I just wanted to answer a few questions, just in reference to where I came in as far as infinite banking is concerned, and where I came from in the whole 9 yards. So, I guess I could say my immediate background is for the past 10 years I have been a final expense life insurance agent. Now, final expense is simply life insurance, but it's more geared towards burial insurance. That's what people call it, burial insurance or funeral insurance. So that's what people have called it. So that's what I've been doing for the last 10 years. So my clientele would be very different from, if you would say, an infinite banking clientele, or mostly different from infinite banking clientele. So infinite banking for me was a whole new, I guess, venture, that kind of say it that way. And I have been hearing about it for a while in different places from different things. And I've been so intrigued by it, but I never could get all the details that I needed, because I would ask specific questions, want to know specific things, and I could never get that detail about that. So what happened was, I would probably say, not I'll probably say, it was like 2022 July 24th. I fell off of my mountain bike. I was injured and fell off a mountain bike, and I broke my proximal humerus bone. So the corny joke is, it wasn't funny at all. And when I broke that bone, I thought my arm was dislocated. So I went to the emergency room. They did the x-rays, everything like that, and found out that I had broke my proximal humerus bone. So needless to say, I was in a lot of pain, couldn't really move, and had to get surgery scheduled. Well, I guess I could have let it heal, but I opted for surgery, and them to put more metal in my body. And I was like, I'm 51 years old and I never broke a bone, and here I am. So yeah. And it was August 3rd. August 3rd, I was in the hospital. I had surgery that day. I couldn't sleep. I just couldn't sleep. Now, I had, again, studied infinite banking, or I should say I studied the concept to try to find answers. And I was just looking. Came across this one video, and this one video with a gentleman named Devin Burr. And the video was probably 42 seconds long, if that, maybe a minute. But I watched the video at least 15 times. Every time I watched it, I got a new revelation. I'm talking about a video that was literally 42 minutes to a minute, 42 seconds to a minute long. And I just kept watching. Turn my phone off here. And I was just like, what in the world did he just say? I said, what did this guy just say? And I was like, I could not believe it, because I was like, okay, wait a minute. Did he just say what I thought he said? And I just kept playing. And there was a video talking about how he used a policy to buy a car, and then he paid he leased it to his business, and then he was paying himself. His business was paying him for the car, and he generated a tax write-off. And I was just like, what did you just say? It was the craziest thing, because I was like, did I just hear that right? So I just kept playing and playing and playing. Well, that led me down a rabbit hole. I just kept going deeper and deeper. Infinite banking, I looked at a presentation that was 53 minutes long. And I was like, wow, this is a long, it was maybe an hour long. This is a long presentation. But I didn't have anything else to do. I was in the hospital, on medication, and they kept bringing me medication. I couldn't sleep. I could not sleep. They even gave me melatonin. I couldn't sleep. I was so excited and angry at the same time. I could not sleep. I was angry because I was like, yo, nobody has told me about this. And I know there's people that I know who have used the infinite banking strategy. I know it. Because I looked at some people's lives, some people I knew was happening. Then I was excited because I was like, yo, this is crazy. Where did this come from? And that was the kind of the journey that I went on. And my wife and I got our own policy, and we got a policy, and we started putting money into the policy. And the craziest thing, man, this policy was able to give us an immediate return on our money, right? So we didn't have it gave us immediate return on our money, but it didn't give us the exact amount that we put in. But as time goes on, we'll be able to get more money out of the policy. So that was the thing I was like, wait a minute. So I put this money in. So I would say I put the money in on a, I think it was like a Tuesday. It was available probably on a Wednesday. Probably 60% of the money was available on a, like a, not, no, sorry, Tuesday, Wednesday of like the next week. It just took a little while to get actually drafted from my account. And I was like, okay, so 60% of the money was available in about a week. And I was like, what? So I was like, all right, wait a minute. How long is it going to take me to get this money? And they said it's going to take, if you have it mailed, it's going to take about 7 days, 10 days probably in the mail. But if you have it direct deposit, it's about 2 to 3. And I was like, well, all day long, 2 to 3. Well, at this particular time, we went through a mapping program. So with our the people that I worked with, they took me from the inception call, from talking me through the whole process, to actually creating the policy. And that was the deal. You have to create the right policy. So you have to have a whole life policy specifically designed for infinite banking, with a mutual company, and that was the key. You have to have the policy like that. And I'm a life insurance agent. So let me just say this: I'm a life insurance agent. I was just reading text message, and when I looked at a lot of the videos that were online talking about infinite banking, there's not a lot of life insurance agents talking about it. And I was like, well, why? Most of the people were talking about it from the real estate perspective. They were all real estate agents. They were talking about it. But I was like, well, why? I mean, why are the life insurance agents not, getting involved with this, or understanding this, or taking advantage of this? And it was apparent to me once I asked more questions, I understood why. With an infinite banking policy or a whole life policy with a mutual company specifically structured to and designed for infinite banking, the life insurance agents that offer this don't get paid their maximum commissions because of the fact of the way that the policy is designed. So it would not behoove them, it would not be advantageous for them to talk about a policy like this because they can't make their maximum commission. That was backwards to me. I was like, wait a minute. I have an opportunity to help somebody get out of their financial situation where they are, and I'm holding back the information because I'm not going to get paid my maximum commission. That ain't right. That just was like, that's whack, right? So I was like, okay, that's just not a cool thing. So I understood it, and it made sense to me, and I knew why it was not something that was heavily taught in my community. When I say my community, I mean my life insurance community. And most of the people that were talking about it were using it for real estate. So they would use it. So here's the crazy thing about the policy. This is the first time you hearing about this, looking at it, seeing me, whatever. The biggest thing about this policy is that you can borrow from the cash value. So let me say it differently. Your cash value is treated as collateral. You borrow from the life insurance company the death benefit that you have. So with most policies, they teach about death benefit. Especially in my industry, death benefit, that's all they talk about. But the deal with this is it's about the living benefit, the cash value. So you can use the cash value, you can borrow, use the cash value as collateral. And I would hear all the time, why would I borrow from myself and then have to pay myself back? Well, I don't understand why that wouldn't be a beautiful thing. Why not borrow from yourself and pay yourself back? You borrow from the bank and pay the bank back. So why not borrow from yourself and pay the bank back? But that's not really what happens. What it happens is you borrow from the death benefit. You borrow from the life insurance company. Your cash value is treated as collateral. The premiums that you pay are more of a deposit and not necessarily as a bill. So if you treat your premiums as a deposit, not as a bill that you have to pay, you look at it whole differently. That's where the whole become the bank. I am my bank, right? I'm my own bank, and I own my bank because you now become the banker in this situation. So you actually make deposits, not pay premiums, make deposits. The cash value continues to increase. You can use the cash value as collateral to borrow the life insurance company's money from their general fund. Boom. Here's the key. The cash value that you borrow or the cash value that you use as collateral stays in the policy and continues to compound and grow at an interest rate somewhere usually around 4%. And because of these are mutually owned life insurance companies, I'm a mutual owner in there. Basically, I'm a part owner in the company. I own a little sliver of the company. When the company does well, which they have done for over 100 and some of these companies, 130, 150 years, 160 years, have done well, they pay out a dividend, which now takes the interest rate, I talk about 4%. The dividend is not guaranteed, but they paid dividends for the last 100 years through the Great Depression, through the Civil War, through the whatever major catastrophe, the recession of 2008, they've always paid dividends. So even though a dividend is not guaranteed, they've always paid it, and usually somewhere around 2%. So now I'm earning about 6% on the money, the cash value. So I borrowed against it. The cash value is still sitting there. The cash value is still earning interest. I don't know if you get that, right? So I was like, wait a minute, my cash value is still earning interest? And I just borrowed the life insurance company's money and I go invest it and use it to create more money, or just use it to live my life like I normally live my life and then pay myself back or pay the policy back with interest that I would have paid anyway if I borrowed the money from the bank. Huh? I don't know about you, but that right there, that changed the game for me, because you can do the same thing over again. You do it, rinse and repeat. Do it, rinse and repeat. Rinse and repeat. So let me break it down to you. Let me tell you how it made sense to me. So 2 ways. Let's say you have debt, right? I don't care how much debt you have. Credit card debt, student loans, whatever it is. Now you can, the money that you had, so if you paid the debt down, period, just paid it down. Put money on it, paid it down. That money's gone. You'll never see that money again. You can never get it back. You've lost opportunity costs with that money, because if an opportunity came up and you wanted to use that money, you can't use it anymore because you just used it to pay your debt down. I paid my debt down to 0. I'm killing the game. Well, you can't use that money again. But if you take the money from your policy, if you get a policy loan, pay the debt down, and you were going to pay that debt anyway, and you pay that back to yourself, to your policy, with interest, your cash value just went up. So now you're already earning a interest rate and a dividend on your cash value. You pay it back with interest. You paid back your policy more money than you actually, or I should say, you paid back your policy with interest, and you paid the loan back plus interest. Now your cash value has gone up. It ultimately increases your debt benefit as well. But that's something down the line. That's, if you don't pay that loan back, they're going to get it anyway. They're not stupid. They're going to get it from that death benefit when you die. So guaranteed you're going to die. Guaranteed you're going to make interest on the money. That's guaranteed. Guaranteed interest rate. What? So listen. So eventually, if you have debt and you pay the debt off, well, the debt is going to go away, and now you can start putting more money into your policy. So if you were using a credit card, now you don't have to use that credit card. Put the money in your policy, borrow the money from your policy, use it as if you would have. So you want to go on a vacation. Hey, you know what? This vacation is $3,000. Go to your policy, get the $3,000, pay yourself back. You pay yourself back with interest. You're gaining interest because the money you borrow from the policy is still sitting in the policy in the cash value, earning interest. And you just borrowed the life insurance company's money. Money company, the money, but the company, right? Exactly. If your head is spinning, this is how my head was. I was like, what? So let's take it to a bigger purchase. So you're going to buy a car, right? You're going to buy a car anyway. You're definitely going to buy a car. So let's say the car is $20,000. You go to buy the car. So instead of you going to the life insurance company, so I'm going to say this. Yes, the life insurance company charges you interest about 5% when you borrow the money. Absolutely. So, you know, it's still one of the lowest interest rates. It's lower than your credit card. It's lower than your student loan. It's just lower than the car loan. It's lower. It's 5%. So, but if you understand something about when you borrow money, eventually, when you borrow money, the amount of interest that you're going to pay is going to decrease. But because your policy is paying you interest, that's going to increase. So you have decreasing interest on your loan and increasing interest on your policy. Not that the interest increase, but that what you're paying into the policy is going to increase. So even if the interest rate on your debt is lower than the interest rate on the even if the interest rate on the policy is higher than the interest rate on the loan that you take out, eventually it's going to go like this, right? And your interest rate that you're being paid is going to start surpassing the interest rate that you're paying on your debt, right? Yeah. So let's say you have a car loan. Let's say you take a car loan, right? You got $20,000 in your policy, cash value. You take $20,000 out of the policy of cash value, and you buy the car outright, straight up. This is a part of the video that kept me up. This is what I was told in the video that kind of kept me. You pay it out straight up, $20,000. So now you own the car outright. But now you have a debt in your policy. No, I'm sorry. Now you have a loan for your policy, right, of $20,000 at a 5% interest rate. And they're paying you 3 to 6% interest, including the dividend. So eventually that 5% interest rate that you have to pay is going to be lower because you're paying it back, and that's going to start. So it's going to start going like that. So it may start like this: loan interest rate, what you have to pay into it, and then eventually it's going to start going like this, because what you pay into it and plus what the interest you're going to earn, you're going to decrease what you owe and earn more. So it's going to do that. It is just going to do that. It's just the way it works. So now you own the car outright. You're paying your car back. I don't know. Let's say you pay it back $500 a month. That includes the interest. You're paying it back every single month. You do that for 3 years. At the end of the 3 years, you own the car. Car sitting in the driveway, right? And you earned probably about $3,000 more that the bank would have gotten if you would have took out a bank loan. $3,000 to $5,000 more. I'm not doing the math. I'm just trying to give you an idea. So so let's say it's $25,000. Your $20,000 car that you now own after 3 years, and you earn $5,000 of interest into your policy, back, cash value, that now you can just do it again. So when you do a traditional loan, usually what you have to do is you have to give up one or the other. You got to give up the money or the car, one or the other, right? But with this one, you got the car and you got the money and the interest. You can't beat that with a bat. So understanding infinite banking, now, of course, this is a little bit more involved than that, but I said in one of my videos, if that didn't just piss you off, then infinite banking is not for you, because the bank takes your money and they use it for their benefit. They only pay you about 0.01%, right? To me, that's on a good day, right? Yeah, you can find a bank, a bank that may pay you a little bit more interest, but normally it's not going to happen. So you put your money in the bank and they give you a 0.01%, but then they go over there to Sally homeowner. She gets a loan for a home. The seller puts the money back into the bank, right? Go buy a car, buy a car. They put the The car dealership puts the money back in the bank. Get a construction loan, right, from the bank. All of these are charging interest rates. They're more than 4%, right? They're more than 1%. The bank is giving you 1%, but they're charging all these other people to use your money 4%, 8%, 9%, 12%. And they're making a profit. At the end of the day, how much do you think the banks make? You can go look it up. Banks on average make 400 to 1,300%. 400 to 1,300% profit. You can look it up. It's online. But you can look up your bank, and let me see if I can find the name of it where you can go look for it. You can look up your bank. I can't find it right now, but you can go look up your bank and see how much profit your bank made. 400 to 1,300%. I probably have another video where you can look it up. I'm like, what? Are you kidding me? What? 400 to 1,300%. And they're only paying you 0.01%? How dare they? Again, if that doesn't piss you off, Infinite Bank is not for you. You can keep on putting your money in the bank. Go. Keep putting your money in the bank. I know I'm not. That ain't happening for me. So that was kind of like my journey, man. I was like, yo, this is crazy. And the hardest thing is to try to explain this to somebody who's been ingrained. We've been indoctrinated into the way it's supposed to be done. 401ks, it's a lie. Just a lie, man. Stock market, unstable, unsecure, right? So all these ways we were told this is the way that you need to do your money. You know, I was taught, get a checking account, get a savings account. That's what I knew. And yeah, that failed me. So I know for a fact that I've lost millions of dollars. Millions of dollars. Because I bank the way I was taught to bank. I bank the way most people bank. And because of that, I've lost millions of dollars. So if you see me here doing, you know, this impromptu talk, is because I'm a real dude. Like, I'm checking my phone, I'm looking at text messages I'm getting. You hear the text messages come in. But the deal is that I'm just like you, right? Especially as life insurance agents. When you look at a life insurance agent who does this, like life insurance agents don't do this. I'm going to tell you this. I'm going to end it. I had a fund, a place where I would put my money every month. So I wouldn't take a full commission from my life insurance agency, from the life insurance company. I would just take a portion of it and leave the other sitting, so that at the end of the year, I would take that money, pay my taxes, right? Or do whatever, go on vacation, whatever, have a Merry Christmas, whatever. I would take that money and do that, right? Well, that money was just sitting. It wasn't earning any interest. It was just sitting. I just had the money sitting there. And it got into the thousands, just sitting there. If I had a properly designed whole life policy with a mutual company, properly designed, that money would have made me money over time. In the years, I've been an agent for 10 years at the time of recording this video. The money that I lost, are you kidding me? I was told long time ago, 3 ways to make money. You make money. People make money. You have a team of people that makes money. The first one is actively making money, active income. Second way is a passive income, but someone active, but people helping, cooperative economics. A lot of people doing a little bit getting done. And then the third way is your money make money. Now that's the way you want it to be, because your money making money for you. I mean, if I would have years ago put that money into a infinite banking, so the life insurance is the life insurance. It's not a product. It is what it is. It's a whole life insurance policy. the concept, infinite banking is a concept. So I can't sell you infinite banking. I can't say, hey, you know what, I got this infinite banking here, you know. Let me how much you willing to spend for it? I got some infinite banking, I want to give it out. No, it's not something I'm selling. Infinite banking is a concept. So the concept takes what the policy can do and puts it on steroids, right? So I don't even think about it. I'm not going to do the math, how much money I lost by just having my money set. So listen, if you didn't know what infinite banking was, hopefully this video kind of brought you some clarity on it. But if it didn't, you know, click the link in the bio. We got people who can help you out, talk to you about it, and help you, you know, get something started for yourself, and you know, get you out of debt. If you want to invest and do more things with your money and have your money work for you, we can do that for you too. We can help you out with that. But yeah, my name is Will Love, and I am a final expense life insurance agent who was ignorant for years about infinite banking. And people that I know use the policy or use this concept never told me about it. So I'm going to do the opposite. I'm telling everybody. All right. Great. Hopefully this can help some people and, you know, put you in a different situation. Take care. Look forward to talking to you. Bye-bye.